Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SOUTHWEST Airlines Co. quarterly report. SOUTHWEST Airlines offers a wide range of businesses and services to its customers. These include scheduled air transportation services, in-flight entertainment and connectivity services, Rapid Rewards loyalty program for earning points on base fares digital platforms, including websites and apps for customer support SWABIZ, an online booking tool, ancillary services such as plus Southwest's early bird check-in, plus upgraded boarding, plus transportation of pets, plus transportation of unaccompanied minors. SOUTHWEST Airlines Co.'s stock price has experienced a notable increase over the past year, with a 13.2% gain in the 3 months leading up to October 2024. Several factors contributed to this growth: improved third-quarter outlook due to strengthening industry demand and effective revenue management strategies, additional revenues from industry disruptions caused by a global technology outage in July 2024, lower anticipated fuel costs, projected at $2.50-$3.60 per gallon for the third quarter of 2024. These positive developments collectively contributed to the company's stock price increase of over 9.61% within the past year. The primary drivers of revenue growth or decline can be summarized into 3 key areas: passenger revenue, revenue initiatives, and air traffic liability. Revenue growth is primarily driven by an increase in average passenger fare, particularly through the introduction of bag fees, which generated $79 million in additional revenue. Additionally, higher ticket sales led to a significant increase in air traffic liability, totaling $421 million. Breakage revenue adjustments also contributed to revenue growth. On the other hand, revenue decline is attributed to decreases in freight and other revenue streams. Passenger non-loyalty revenue declined by 4%, while passenger loyalty revenue decreased by 10%. The number of revenue passengers carried also dropped by 5.5%. These factors collectively led to a decrease in overall revenue. Net income and profit margins decline. A summary of the changes: the company's net income has experienced a significant decline over the past year. For the 3 months ended September 30, 2025, net income decreased by 20% from $67 million to $54 million. This trend continued for the 9 months ended September 30, 2025, with a staggering 42% drop from $204 million to $118 million. Profit margins have also taken a hit, with operating income margin decreasing from 0.6% in 2024 to 0.5% in 2025 for the 3-month period, and from 0.3% in 2024 to 0.2% in 2025 for the 9-month period. The primary reasons behind these declines are unrealized losses on fuel derivative instruments, changes in other comprehensive income/loss, decreased revenue recognition for co-brand credit card benefits and marketing/advertising revenue, increased salaries and wages expenses, and landing fees and airport rentals. Additionally, a decrease in fuel and oil expense was offset by higher passenger revenue. These factors have collectively contributed to the decline in net income and profit margins, indicating a challenging period for the company's financial performance. The company is indeed generating positive operating cash flow, as evident from the financial summary. The data on pages 11 and 54 confirm this, with operating cash flows of $287 million, 3 months, and $1,547 million, 9 months being reported as positive. This indicates a strong financial position for the company, allowing it to generate sufficient cash from its operations to meet its obligations. The company's debt level and interest expenses have undergone significant changes in recent periods. Notably, the long-term debt decreased by $1,990 million from December 31, 2024 to September 30, 2025. Additionally, current maturities of long-term debt also saw a substantial decrease of $1,607 million during the same period. Furthermore, convertible senior notes due 2025 were repaid in full during the second quarter of 2025. In terms of interest expenses, there was a notable decline of 44% from September 30, 2024 to September 30, 2025. The company's interest expense also decreased by $71 million, 37.2%, from 2024 to 2025. However, capitalized interest increased by 58.3% during the same period. Overall, these changes indicate a reduction in the company's debt burden and lower interest expenses, which could have positive implications for its financial health. Management's outlook and strategy. The company expects a positive outlook for its fourth quarter 2025 results, with anticipated increases in unit revenues, 1-3% year-over-year, an all-time quarterly record revenue performance. Operating income is expected to decrease due to higher expenses and lower fuel costs, but partially offset by increased passenger revenue. The company's capital spending for 2025 is projected to be between $2.5 billion and $3 billion. Management also aims to improve financial performance, drive shareholder value, optimize capital allocation, and reduce costs in the coming years. The company has made several strategic moves through acquisitions and divestitures. Key acquisitions include partnerships with China Airlines and EVA Air, as well as the purchase of new aircraft and technology assets. These deals are expected to enhance operations and expand services. On the other hand, the company has also divested certain assets, including terminating its fuel hedging contracts in 2025. This move is aimed at reducing risk and improving financial stability. The company has a history of paying dividends. According to the financial summary, it is confirmed that dividends were paid in Q3 2025, amounting to $189 million. Furthermore, page 28 explicitly states dividends paid, yes, solidifying this fact. The total dividend payments for both 2024 and 2025 are also listed on page 54, providing a clear indication of the company's commitment to rewarding its shareholders through dividends. Concerns about inventory buildup and supply chain disruption exist. The company faces significant challenges in its supply chain, posing risks to inventory buildup and disruption. Boeing's manufacturing difficulties and delayed FAA certification of MAX aircraft have contributed to these issues, page 29. Furthermore, the reliance on third-party vendors for critical aspects such as technology plans, fuel supply, and maintenance, page 57, exacerbates concerns about potential disruptions. These vulnerabilities highlight the need for proactive measures to mitigate risks and ensure a stable supply chain. That concludes the financial summary for Southwest Airlines Co. Feel free to comment below, and I will be happy to answer them when possible.